Over the past several years, markets have seen narratives amplify, passive flows concentrate capital, and volatility obscure underlying value. In environments like this, when dispersion widens and active risk management matters, differentiating between beta and discipline becomes critical. Today, I'm joined by Chief Investment Officer and Portfolio Manager Greg Taylor to talk about alternative equity, active risk management, and why excess returns with lower volatility don't happen by accident. They're engineered through process.
This podcast is for information purposes only. It should not be viewed as investment advice or as an offer to buy or sell Pender's funds. Our funds are not guaranteed, and any discussion of past performance is not an indicator of future results. Any opinions expressed are as of the date of this podcast and are subject to change. Pender may not necessarily share the opinions of our podcast guests. More important information can be found on our website, penderfund.com/disclaimer.
Greg, it's great to have you and welcome to the podcast.
Well, thanks, Laura, for having me and providing such a nice background with the firm.
Yes, we're working on getting our second one so you can be between two ferns.
Exactly. Look forward to that.
So how about we start with you? You joined Pender last year after about 2 decades in portfolio management and risk roles. How would you describe your philosophy as a capital allocator today?
Yeah, so when I started, and I feel like a bit of a dinosaur now, I started in 99. So right at the peak of the dot-com boom. And I started at a firm called Orient Capital, which had just spun out of Shell Canada. So at that point in time, Shell Canada's fund was fully in-house managed with equities, fixed income, and growth. And I joined the equity team. So joined the equity team in November of 99. There's one other PM and a trader, and I was joined as the analyst basically, and they threw me into the tech sector. I said, deal with these tech stocks. The dot-coms are going crazy. And that was great for a few months until everything you bought started to go down. And suddenly become very cynical because everything starts to blow up and go down. But it was a great place to learn. Oregon went on to grow. We were about 500 million when I joined. It grew to about 5 billion before we got bought by Scotia in 2008. But it was a great place to learn because we were more thought of as a growth manager, which growth in Canada is a bit of an oxymoron, or maybe a chameleon's the better word because it changes. So started off as focusing on technology, then quickly became a resource manager because the resource stocks started to take off as China emerged. And then that pivoted to be biotech, to a point from time cannabis, to a point in time back to technology. So focusing on growth in Canada is a lot of different things. But the main constant that I had through the Orient experience was we took the stance of most people look at trading as a cost center. So if it's a cost center for someone, it's going to be a profit center for someone else. So we took the tact of being more active managements, trade actively around positions and try and exert value from that. So we do the fundamental work, but then we try to add value through active management. And that's really how I learned the business and how I started my career, and something I still do to this day, looking at active management and trading as a way to add value and complement returns in your portfolio.
Yeah, and it's interesting because we've seen that, as we said, that kind of movement towards passive, and the number of active managers out there has gotten a little bit smaller. Would that experience in the past have changed, I don't know, how you make decisions and ensuring that you aren't just benchmark hugging like we've seen some of our, I guess, other competitors out there?
Yeah, and I think it's a good point because active management also became a bad word for a while because across North America, it was hard for equity managers to really beat benchmarks. And that became part of a concentration issue. And Canada is probably one of the markets that got hit by the concentration issue as fast as anyone. Again, going back to 99, that was in the glory days of when Nortel was 35% of the TSX and Bell, which was owned part of Nortel, was another 15. So basically one stock was 50% of the index, and that caused a lot of concentration in benchmarks. And also from an active management point of view, no one in their right mind would ever put 50% of their portfolio into one stock. So it takes away from portfolio theory, and it makes it hard to keep up when those stocks are going. And we've seen that a lot in the last few years with the growth of the Magnificent Seven in the US, with that group becoming, I guess, probably close to 40 or 50% of the S&P 500 in market cap. So what that's done is made, I'm going to say, investors generally more complacent than anything else. And they've kind of gotten that they're not taking on a lot of risks, they're not doing the work. And they're just saying, I'll just buy the index and not have to worry because it's always going to work because for the last 10 years it has. And I think we're starting to see that pendulum swing back the other way. And I think that's where passive investing is becoming a little more dangerous. And because you do have to acknowledge you've got some concentration in your portfolio. And if you're not dealing with that, that can be something that's kind of an unforeseen risk that's out there that you really might not know in your portfolio. You think you've got a nice balanced index fund, but it's really concentrated in a few factors. And if those factors go the other way, it can really hurt returns.
Yeah. I mean, especially in times like now where we've seen AI really taking over the narrative and just increased volatility. It is something that we talk about in our investment meetings. It is exciting to be an active manager when there is so much opportunity out there to make decisions and not just observe.
Well, it's interesting to see how that AI narrative has changed, because I think it's really kind of been something that I think throughout the last 15 years, AI has been in that background as the next big theme that's going to take over. And it's been going on, and everyone talks about how they're using it, and ChatGPT kind of emerged, and then OpenAI has taken over. And then suddenly it became that everyone and their brother had to own some NVIDIA stock because of the AI build-up for semiconductors. And that really took off from a hardware point of view. And then that pivoted back to the data centers. And then now more recently, we're starting to see, well, wait, is AI going to kill the software sector? And it's interesting just how this whole AI theme has changed over time, and made it that it's a theme that went from being the greatest thing in the world to, wait, is this going to really affect the economy and kill white collar jobs? So it's interesting how these themes can pivot quite quickly. And it's kind of a fear of the unknown, as we don't really know what the end result is going to be, and it's too soon to tell. But there's going to be volatility, and I think that again goes back to why passive is going to be something that you're going to have to be really careful with right now, because we do have a big concentration on a lot of these themes in the passive indices, and we really don't know how that's going to play out.
Yeah. So I know we've talked about 99 a little bit, but would that be the kind of the experience that you would see is most similar to today, where decision-making was at that point paramount as it is today? Or is there another experience that you kind of draw, another time frame that you kind of draw to when you think about the opportunities now?
Well, I think the parallels with 99 are really similar, and that's where everyone keeps going to that. And again, yeah. It was the first part of my career, so it was kind of, you're coming in deer in headlights and seeing all these companies, and Nortel and JDS and Celestica and CMAC and all these things that just took off and became dominant parts of the index, and valuations went crazy, and then suddenly it all stopped and it rolled over, and pets.com and some of these other companies completely went to zero. But out of that, you had Amazon emerge, and you had some really successful companies that are still around today, and monsters in the industry. And I think that's kind of the stage we're going to be getting to now, of is who's going to win. But we're kind of in those early innings where we still don't really know what the business model is it's going to win, how it's going to play out. So the parallels are there because of the hype around a massive theme and the money being thrown at it. But it's really going to be difficult to see who's going to win this, whether it's all commoditized at the end of the day, who's going to be the person to build the apps off of this. Because when you look at the dot-com crisis, or not dot-com bubble, a lot of that was all in the hardware, building out the internet and the network that comes out of it. But the companies that won are the Microsofts, the Facebooks, the Googles, the guys that built apps on top of that infrastructure. So we've got AI right now. There's a lot of themes about the hardware excitement around it, but who's going to build the killer app in AI that's going to win? And I think that's still too soon to tell. So lots of parallels, but I still think it's too early to say who's going to win and what's going to play out.
Yeah, I guess looking also at that experience, knowing that there were companies like pets.com and more than a handful of a lot of others that maybe weren't successful. How did the experience of seeing sort of the losers impact how you look at risk today? Because as AI does move forward, there obviously are going to be beneficiaries as well as companies that don't survive or even have a terminal value of zero. So how do you look at risk on a broader scale?
Well, I think there's a few things. And one of the gentlemen I worked with throughout my career had a lot of great phrases. So I'll kind of drop a few phrases in. But I kept remembering him say a number of times, don't confuse a bull market with brains. And I think that's something that people need to be aware of, that Just because you put AI or the theme of the day in your press release doesn't mean you're actually doing it. And I think there's a lot of tools now, especially with algorithmic trading and such, that are just going to buy blindly depending on press releases. And I think when you get into these manias or hype cycles, what you really need to do to mitigate that risk is to do your own work and try and figure out, are they actually doing what they're saying? Are they actually adding value? Are they creating moats to make it so other people can't just copy them? And those companies that are doing that, I think, are going to be the long-term winners versus companies that are just jumping from press release to press release, trying to come up with something that's going to catch someone's attention and get their stock higher, because there's a metric of price to press release, which never really plays out well. So working on figuring out who are the fundamental investors that are actually going to come out and do things on the right side and do the work.
Yeah, no, it's been very interesting to just see how algorithms, even just from a trading perspective, have driven prices, and how companies have strategically worded press releases knowing what's a benefit from that algorithmic side. So it's an interesting thing to watch for sure. But I guess just moving from that risk first mindset, it does sort of lead directly into the fund that we're going to talk about today, and that's the Alternative Select Equity Fund. Maybe if you could just explain in as simple language as possible what exactly the fund is and how it's different from the other offerings here at Pender.
Yeah, so I'll give a super quick history of the fund, because I think that plays into the narrative of how it came to be and how I'm managing it. But so getting back to Orion in the early 2000s, that again was a long-only Canada-only pension fund run with a growth mandate. And we were having a lot of good success with the benchmark and growing the fund. But with our scale, there were a lot of ideas that we just weren't taking advantage of because they were too small, they were too niche, they were smaller cap companies. So we created a fund called Orion 2, for lack of a better term, which was just a friends and family OM mutual fund, so more of a hedge fund. And that was set up to do things that the pension fund couldn't do because it just didn't fit. Also would be more concentrated, would also go to the US, and also allow us to short sell or to use some of these more hedge fund strategies of short selling options, overlays, some more concentrated positions. So that's when the fund started. Again, friends and family, kind of a sidecar vehicle to a bigger pension fund product. That fund evolved over time as we went through different iterations. When at one point it was a resource-focused fund, then it became a little more heavily in privates, and then more broadly diversified. That fund followed me from Orion to Scotiabank to, then I took it to Front Street. And at Front Street is really where I started to evolve how I'd manage it, from focusing on more risk controls and making it more diversified and more sectors, focusing on themes, and also focusing on the downside capture to make sure it wasn't having a lot more undue volatility. So that's more back in 2015 is when those changes started to make. The fund stayed at Front Street for a few years until we were acquired through a series of transactions to go to purpose funds. So it became a purpose investments fund. And then when I left purpose the summer of last year, came to Pender. So that's the Pender Select Equity Fund. So the fund has had, I guess, 5 different names, but it's the exact same pool of assets. A bit of a varying degree of investment philosophies at the beginning, but for the last 10 plus years, it's been pretty consistent, and similar investors and a bit of a decent track record through some volatile horizons. So that's the quick history of the fund. And really what it's set up to do, again, is be more of an absolute return vehicle that's going to be a growth fund. So it's part of the growth part of your investment the portfolio. I like to think of it as more of a satellite approach. If you've got your core fund that's going to be more of the index, look like the benchmark, whatever, this is a fund that's going to go in places that most people don't want to go to because it's a lot more work, a lot more volatile, and but more niche sectors. So I try and skew more to growth sectors more than anything else. I'm not really going to own banks in this fund. It's not going to be telcos. There's going to be a few telcos when they're on the growthy side, but it's more focused on resources, materials, technology, sometimes healthcare, some consumer where there's growth, but really focusing on different parts of the market that can move around, be a little more volatile, and can offer some outside alpha capture if you get the themes right. So that's the area of the focus of the hunting ground of what we look at. And then really to concentrate on this theory is I look at 3 or 4 big themes that I would think are going to be around in the market for the next few years, and make sure that those are the themes that the fund's concentrated on, and really focus on that. And then through stock selection, use technical analysis, some fundamental analysis to focus on names, and then overlay that with active trading, some short selling, and some overlays from options overlays to protect on the downside.
Okay. So definitely a lot going on below the surface. Yeah. I know one of our other PMs describes his fund as there's a duck on the surface, but you can't see the legs pumping under the waters. I guess a little bit like that. There's a lot of different things happening. Knowing that you've managed this strategy for as long as you have, given its history, how has the philosophy held up through different market cycles, and how do you adapt as things change?
Yeah, so in the last, I'm going to say 6-7 years, so going back to like 18, 19, it is really more focused on downside capture. And I think that's really what we started to learn, is that anyone could buy beta, and the markets had done a really good job, and keeping upside was not the issue. It was making sure that you didn't ride these sine waves down when things start to change. And I'm spending more time focusing on just how to sell. And I still think when you look at from a trading point of view, selling and short selling are the hardest things to do in investing. Not saying it's easy to buy the next NVIDIA or those type of names that go up straight up, but knowing when to sell them and not sell for these names when they double the first time is also incredibly difficult. So what I've been trying to do is build in more of a discipline around selling, trimming positions, trimming winners, and making sure that you're not going to blow up and ride a cycle, make a home run become a zero. So when you've got something that's working, make sure you're actively managing that position by trimming in the strength, adding some short selling hedges or in that, and really, again, focusing on that downside capture. So the whole goal is, again, hopefully keep above market positive returns, but better than market negative returns. So you don't really ride everything down the cycle. And that's really the biggest evolution we've done with the fund in the last few years.
Yeah. And when you mentioned earlier as well, just with how concentrated the market, both in Canada and the US, has become just with those large winners, does that create opportunity for a fund like yours?
Yeah. And I think it does, because you want to be, I'm trying to focus on parts of the market that I can be nimble in, and try and make sure that I'm not going to be concentrated in big names that are just driving the market, and try and make sure it look different from that. It's also going to be interesting if we do get both in a period that's going to have higher volatility, because you can move around a lot in that. But also if you do get into a period of market where you can get IPOs or corporate activity or new issues, because that's something that index funds can't really play in. Because they're by their design, they're just buying the index and not taking advantage of a lot of these different events that happen in the market. So it does feel like that cycle is getting upon us. The resource cycle going on in Canada, and we're starting with that. Usually comes more corporate activity. So being able to participate in that is something that this fund does and can add some value versus index funds. And again, focusing on downside protection is something that index funds do not do. It's just not in their mandate. And that's something that I think is in the back of everyone's mind after we're looking at 3 pretty good years here in the TSX. And I think everyone's starting to look at valuations and become a little more concerned and ready to maybe step one foot off the edge of the dance floor to try and stay a little closer to the exit. But they still want to play in the game. So having some funds that are going to have some downside protection, some strategies that are going to help to minimize volatility, I think are going to play out well here.
Yeah, I guess we've seen the TSX done so well, but it has been fairly concentrated in a few sectors, resources, like you mentioned, being a huge beneficiary. I guess as you do have sector rotation embedded in the strategy, what opportunities are you seeing at this point when you look at potential names to add or potential sectors to add more exposure to?
Yeah, so really I've got a few themes I can touch on that are in the fund right now, and they've been pretty consistent for the last, I'm going to say, close to 2 years within the fund. But the thing is, within these themes, the things change, and there's different ways to express them, and that's really what I've been concentrating on. So quickly, the big themes that we're looking at, number one is I think we're in a lower dollar world for a while, and with that, that's going to be a case for real assets, so we can get into that later. Number two is AI, which we touched on. AI is a big driving force in technology and other areas, and you need to have a view on that because that's not going away. The third theme is really this infrastructure spend. I think we're starting to see more of it in Canada as we're starting to finally start to build stuff, we hope. And there's going to be a big emphasis on that. And then tied into the infrastructure spend is just this whole push on defense spending, as it does feel like these global threats are going to be with us for a while, and companies are going to be spending more money on this, and there's going to be lots of ways to take advantage of that in your portfolio. So those are the 4 big themes we've got in the portfolio, and there are definitely different ways to address them and look at that under the surface, which we can get into if you want.
Sure. Maybe starting with defense, since when you brought up at the end there. I know when we talked to some other PMs, they don't try and predict macro risk and make a call on certain macro situations that might unfold. Is your strategy different, or how do you position for these types of geopolitical events that are occurring?
Well, it's so in the defense theme, there's really not that many good ways to play it in Canada. So in Canada, we've got a handful of names: the Krakens, the MDAs, the Telesats, which are all great names. Callion's a good name as well, and those have showed up in the portfolio in different varying degrees. We've gone to some of the U.S. names in that, but they're just bigger, more political beasts than anything else. So not as attractive and interested in those. But I think from handicapping geopolitical risk, it's incredibly hard to do, and that's something that you don't really want to make big predictions on this, because there's a lot of people who have tried to do that and been burned on the way. So it's kind of just have a bit of a toe in the water and more just play big themes. And when you can see that the government is shifting to increase their budget and increase defense spending, you kind of want to get ahead of that and not really play for the day-to-day headlines of what's going to happen next in different parts of the world.
Yeah. And I guess that's another thing is maybe since you are spending quite a bit of time looking at this theme as an active manager, passive may not be going into the level of depth or trying to understand these things as they're evolving. And that would potentially offer more opportunity as well. I know Kraken was a good example that we invested in quite early and were able to kind of see a lot of upside from as a result of understanding these types of geopolitical events and beneficiaries as we move forward.
Yeah, and I think Dave Barr and the small cap team have done a great job picking up on these themes. And in Canada, just from a structural point of view, these companies do emerge as small caps first. There's not a lot of big defense companies in the country, and they go on the radar small cap funds first. And those funds and those companies are just not in the benchmark. So your index fund's not going to exposure to these, and this is an incredibly interesting part of the market and has still a lot of potential upside here.
Yeah, for sure. I guess in one of the other themes you mentioned was the hard assets. So would that be more of a resource focus than some of our other funds look at, or how would you describe how you position to gain exposure to hard assets?
Yeah, so I definitely would spend a little more time on the resources, or probably a lot more time on the resources than the other parts of the Pender, the equity team. And part of that's just because my background. I started off running a part of a portfolio that was more resource focused, and I've seen the positive cycles. They really haven't had a good commodity cycle in Canada for a number of years, but when they happen, they're super fun. And I think we're starting to see that over the last 12 months, and I hope everyone's been enjoying it because there's nothing like a resource cycle in Canada to get some excitement going. And PDAC in Toronto, I'm sure, is going to be quite fun. But it's just a great, I think there's a good setup here that this could be a cycle that goes on for a long time. Throughout my career, there's really been two different types of resource cycles. One's led by supply shocks, where there's not a lot of supply out there. So you see a lot of prices go up because there's demand, but there's no supply and there's nothing to come on. And we've had that through different oil crises where there's problems in the Middle East or such, or problems with the copper side where it's more of a supply shock than anything else. The second types of resource cycles are demand led, which we saw in the early 2000s with the building out of China and building the infrastructure. And that was just so much spending on infrastructure and pipelines and roads and airports and everything that caused a ton of demand for commodities. And I think what we're seeing right now is a bit of a combination of both. And I think that's where it's setting up that this could be actually a pretty good cycle, because we are seeing good demand as the rest of the world keeps growing. I think Recession fears are starting to fade for the global economy, and then parts of Asia are doing quite well. But we've also got this whole ESG overhang with such a lack of capital put towards the commodity sector for the last 10 years as everyone focused more on technology. There's just not a lot of new mines coming on. So there's no supply. And the line is you can't order a copper mine on Amazon. Copper mines take 20 years to build. And I think that's starting to surprise people that, hey, why can't I just get all these millions of tons of copper out there? And you just can't, because you need to find the mine, then you need to permit it, then you need to build it, then you need to figure out how to get it to port. And this is setting up to be a multi-year problem as AI, through the knock-on effects, is going to require more copper for the data centers and the power lines, and this is something that's setting up for a fairly good commodity cycle for a number of years. So, commodities are a good portion of this fund, but it also ties into the theory that we're into a lower dollar world, and I think this is going to exacerbate that cycle from a price point of view, because I think everyone's starting to second guess the almighty U.S. dollar. And when most commodities are priced in dollar terms, when the dollar goes lower, the commodity price goes higher. So it's inflationary, but it's also good for real assets. So real assets are still a big theme that's been with us for a while. That's been probably 50% of the fund for the last year and a bit. And I still think that'll remain. So investing that through gold and silver, but also copper and some other commodities as well.
Yeah, I think you mentioned uranium as well, and as a theme that, or I guess a material that you also have exposure to and has a lot of opportunities going forward.
Yeah, so uranium fits into that commodity super cycle theme that I'm looking at, but it also has a neat nuance from an AI theme. So my view on AI investing has kind of pivoted over the last few years, getting away from investing purely in the technology companies or the semi-manufacturers, but also looking at just who's going to supply the power to get these AI data centers going and keep these AI ChatGPT bots working, and that's going to require a lot of power, and with that we just don't have as much in Canada or around the world, and that's where everything's going to be used, like solar, natural gas, coal, as much as a bad word right now, is still going to be used. But I think a commodity that's really coming back on everyone's radar is uranium, and this is a commodity that it kind of was put in the penalty box after Fukushima and some other problems in the world, and Europe was looking at shutting down all their nuclear power plants in France and parts of Germany. But then after the Ukraine invasion by Russia, I think everyone started to realize, well, maybe we shouldn't be buying all our power from Russia, and we started doing it ourselves. And there's not a lot of options in parts of the world other than nuclear power and uranium. So I think that theme is going to be with us for a while, and Canada is setting up perfectly for this, because we have some of the best undeveloped uranium deposits in the world in northern Saskatchewan. So NextGen's a big holding in the fund. Cameco has been holding in the fund. ISO Energy is a position. And I think these are companies that are really set up well to provide the next multiple decades of supply for uranium. And I think this is a theme that's going to be with us for a long time.
Yeah, absolutely. I think people definitely also realize you can't order power off Amazon, no matter how much you wish you could. So
yeah.
All right, so I guess those are the main themes, but what sort of differentiates this fund isn't just your thematic exposure, it's how you express those views. So I thought maybe now we could go into a little bit on your derivative strategy. The fund, being not just long only, is a little bit different than some of our other products. So use short selling and options and active beta management. Could you maybe walk us through what that side of the fund looks like and how you think about your option strategy?
Yeah, it's kind of multifaceted, and this all goes back to the downside capture part of the fund. So once I've established those themes, which again I think are going to be there for a while, you have to figure out how you're going to play that theme. And then within the names I want to hold from that, that's a combination of fundamental analysis and technical analysis for short-term trading, and then just an active overlay of trading around positions that if something goes up 20% in one day for whatever headline, I'm more likely than not to be selling some. And if it's down 20%, I'm more likely not to be buying some. And also within that, I do some pair trades within the sectors. So that's a theme within the fund. And then on top of that, there's two things to control overall macro risk and headlines, and that is that I do have an overlay that I do put on the fund that controls the beta of the product. So it's more of looking at if markets are getting risky, if they've had a big run into year end. I'll just try and take the whole beta fund down by trying to put on some put overlays to try and control the beta of the fund. The second thing is really just simple as cash. And I've done that in the past a few times where if things get really overbought or worried, I'll try and keep the theme still the same, but pro rata, I'll just take the cash level up and the themes down. So in 2022, I went to 50% cash in the fund. Didn't really change the themes, but just really got worried about just the move in the market. So went to 50% cash and kind of waited for the volatility. Then once we did get a pullback, added back on the pro rata to the themes to control that. So this is all just different ways to control for the downside capture of the fund. So pair trades, short selling, options overlays on the top, and then just good old fashioned cash as a defensive mechanism.
Okay, got it. So the goal would be, did you think about it more as volatility smoothing or asymmetric payoffs when you're thinking about options?
I think it's volatility smoothing more than anything else. So I'm not normally going in to try and make a lot of money off of options. It's more just to try and bring from the downside or offer some beta management more than anything else.
And then how about when not in times not like today, but when volatility is low, do you use any combination there? Or is that when you kind of go to a more specific equity only positioning?
Well, so it's kind of the double-edged sword. When the VIX is low, it's cheap to buy insurance. Everyone knows that, but you may not need it. And I think that then it's just going to be a drag in your portfolio and expire worthless. And yeah, you had insurance, but it didn't do anything, and you didn't really need it. And I think that's, people usually ask, what's the worst time in your career? And I almost think back to like 17, 18 was the worst, which is a weird answer because the market was fine. And nothing really blew up. There was a little bit of volatility, but it's really just this smooth year where the market was up 10, 12%. And as an active manager, you can have a hard time proving your worth because the index is doing okay and no one really wants an active strategy that's going to have a lot of hedging on it and trying to find different niche parts of the market. So some volatility is good. So I think you need to take advantage of that. But having hedges in place is something that you don't want to always have them on, but you need to make sure you're timing them and monitor them constantly to make sure it's not going to just be a drag on your portfolio.
Yeah. No, it's kind of what we're circling back to is like when it is volatile and there's a lot going on, it is more exciting. Like even when I was in equity sales, that same time period was a very not fun time also because everything's going up. So you can't really differentiate having an idea. And that was a circumstance where the case for passive was quite strong versus now it's a very different environment, which is exciting.
Yeah, it's kind of what's that Chinese proverb of may live in interesting times. And I don't think there's anyone doubting this is interesting times. So lots of volatility, lots to keep attractive, and I think it's going to be good for active again.
Yeah, for sure. Is there, when you kind of think about the history of the fund, is there a past position that best represents what your strategy is trying to achieve, or a holding that you feels like that was a key story of what Select looks like?
That's an interesting question. So I'm actually even just going to go with the current holding, just maybe because I have more short-term memories and long-term memories. But next gen is still the biggest position in the fund, but it isn't always the biggest position in the fund, and it's not something that I just buy and hold. It's a position that I will be trading around probably a little bit every week, even just as a volatile stock, and it's a theme. It's one of the better companies in Canada, one of my favorite companies, on one of the biggest themes that I can see. But I'm not just going to blindly buy it and just not look at it again for 3 years and hope it all worked out. It's a company that I'm going to be on top of. I'm going to talk to management. I'm going to look at how things are trading, look at the trading pictures, and probably again moving around the weights of the portfolio. Always having a core position, but moving that between, say, 3 and 8% of the fund, depending on my view of it or where the price is. So I think that's a good example of just how managing the different positions. So it's not just a portfolio. If you look at it today, it's not going to look exactly the same a month from now or 6 months from now or a year from now. It's going to be constantly changing around a little bit, tweaks around the edges more than just blanket pulling things out, but just trying to trade around, manage the volatility and smooth out the returns that way.
Yeah, that one too is a good example because I remember a lot of the uranium names did get caught up in AI movements because their specific ETFs or their specific algorithms were trading them for a reason that wasn't actually related to fundamentals. And that's a cool opportunity. It's like, oh, it's down for an unrelated reason, but we still like the company, where you can take advantage as an active manager. I think that was pretty interesting to watch even more recently.
Oh, absolutely. I think you're absolutely right. It's next gen with the whole rise of uranium and the power theme that I was talking about got caught up in a lot of baskets, and basket trading has become one of the big things in the US where people just buy baskets of stocks that are related to a theme. And I guess I'm not going to knock it too much, but uranium stocks that have been put into those baskets as beneficiary of the AI theme. But when something bad happens at OpenAI or CoreWeave or something else, and they just sell those baskets, it's the baby out with the bathwater theory, and NextGen and some friends have been hit, but that's an opportunity. And that's where, again, you want to be watching and paying attention and taking advantage of selling that's more irrational than anything else.
Yeah. No, I remember it was probably maybe 2021 or two where the ESG baskets, it didn't matter what each individual company was doing or what they were exposed to. It was to people like ESG right now, then everything goes up. And if they don't, then everything goes down. And there was a lot of opportunities on the upside and the downside in that circumstance. And it seems like that's only becoming more prominent as passive does become a more impactful portion of the market. So,
well, there's also just fewer people doing active. And I think that's not just a Canada thing, that's around the world. And that offers up a good debate about capital formation and the future of that going down the road. Because you can't have everyone be passive. Because if everyone's passive, no one's pricing anything. And just, I think we're getting close to that tipping point where things have gone too far passive that you're starting to see these wild swings. And again, that's setting up a decent environment for active and making sure you're staying on top of these and doing your work. And I think that's what a lot of the funds here at Pender are doing, is making sure you do the fundamental analysis and be ready to take advantage of these opportunities when they present themselves.
For sure. All right. For our last section, we have a few fun questions. Fun. Not like this hasn't all been joyous.
I'll fade into the tree here.
Yes. Okay, number one. If we fast forward 5 years from today, what do you think investors might misunderstand about this current moment?
Well, that's an interesting one. I think, well, there's a lot of doomsday about just what's going on in the world. And I think the one big thing goes back to the US dollar. And I think we're getting close to a tipping point where people are starting to second guess, is the US dollar the currency forever and the last store reserve? And I think some of the actions coming out of President Trump and such are going to cause more people to question that. So who knows, 5 years is a long way away, but there could be a lot more people looking at other currencies, whether it's gold or commodities, or maybe Bitcoin will rise and stable coins will rise as a platform. But we could be looking at a long-term trend, which is really the peak of the US dollar being used as the store of value.
Yeah, a changing world order, like Ray Dalio say.
It's hard to knock some of those themes because they seem to be playing out in real time right now.
Yeah, no, it's come up a lot in a lot of different rooms. So I'm curious also to see how that plays out. So number two, what do you think will separate the winners from the losers over the next 5 years? Well,
I think you have to be open-minded and ready to move around with different themes, because it is going to be, well, I think I've used the word volatile probably too much already this talk, but I don't see the volatility going away anytime soon. So I think with that, and I'm definitely biased looking at active, but buying just a passive index, I think, is dangerous. And that's not just in equity, that's in fixed income as well, probably even more so in fixed income. So you want to make sure that you're active, doing your work, and getting positioned for these big theme changes that are out there. Because there's some, we feel like we're at that point in time where there's some big secular themes that are shifting, and these are things you need to take advantage of. The good example a few years ago was when the fixed income, when yields started to go up, and some investors had never seen yields go up before, and that changes what duration you need to have in your portfolio. And I think if you missed that theme and just that passive, I think you got burned. So I think we're at the precipice of some more changes coming, and I think you need to make sure you're on top of that.
Yeah, people, it's even from a perspective of the other side of people had only ever seen quite high interest rates, and now they're having to reinvest GIC dollars and realizing that there is a lot less risk-free investment out there. There's a lot of opportunities as well to just take over market share from times that people maybe aren't used to at all, and they've just kind of been able to sit truly passively for the last couple of years.
Yeah, and then that's where you kind of became this whole theme of the death of the 60-40 portfolio. And I think that really came back to that people were just buying the S&P 500 as 60% of their equity, and 40% was U.S. long bonds, and didn't realize that long duration equities are tech stocks. So when you're all tech stocks and long duration bonds, you don't have any negative correlation. You're fully on one trade. And I think that's something that caught people off guard. And again, where passive investing is starting to have an effect.
Yeah, for sure. All right. Last question is one we ask all of our guests. And that is there a book that has influenced how you think about markets that you'd like to recommend to our audience?
Oh, there's so many books. That's the problem. You kind of have to take a little bit from everything. And so I'm going to say that, well, I'm not sure if it's a recent one, but the whole Peter Lynch Random Walk Down Wall Street was probably the first one I read that probably in high school caught my attention and brought me more focus on investing and looking at doing the work and figuring things out. So it's not a new one, but it's an old one and probably one of the classics. I think Liar's Poker is also probably a fantastic one from Michael Lewis, just from a trading point of view and just how volatility works, and just some insights into the bond market and I guess it was the 90s or 80s. So I'd recommend anything by Michael Lewis. I think he's done a fantastic job of just dumbing things down to my level and making it more broadly speaking for everyone to look at. So those are some more classic ones, but there's a lot out there and a lot of good literature.
No, those are great. I'm excited that Random Walk got a shout out because I also very much enjoy that book, and I haven't heard people bring that up before recently. So that's I'm happy with your choice. And also for Liar's Poker, Michael Lewis recently did a look back podcast where he reread it as an audiobook, but then also recorded people from the current time in the same sort of position. So I think it's definitely, they're both still very relevant. So excellent picks.
They're definitely topical. Yeah.
Yes. Well, Greg, thank you so much for joining us today. This was incredibly helpful. And we'll be back in the studio soon with some more conversations. And in the months ahead, we'll be sitting down with different Pender equity portfolio managers each month to explore how they're thinking about opportunity and risk. In the meantime, you can follow our ongoing commentary both on Substack at the Pender Pulse, as well as penderfund.com. Thank you for listening and stay tuned. And thank you, Greg.
Thank you, everyone.
Pender is an independent, employee-owned investment firm located in Vancouver, British Columbia. Our goal is to protect and grow wealth for our investors over time. To achieve this, we seek to understand the quality of a business or security, obtain more value than we are paying for, deploy capital in flexible mandates, and mitigate downside risk. We have a talented investment team of expert analysts, security selectors, and independent thinkers. They manage a suite of niche investment funds with active, concentrated portfolios of value-based, occasionally contrarian investments. We invest in our funds too. You can learn more at penderfund.com.